So today I'm analyzing the quarterly report of the Accelya Solutions which came out last month. This is for Q4 of financial year 2025, that is January to March quarter. I happen to have some shares of this company, that is I own some shares which I bought over the last 1 year. This video or anything I say is not a financial advice nor any sort of recommendation. This is my own analysis of the finances of the company, and I am recording it for future purposes and merely putting it out in public domain. So don't consider this any sort of financial advice or stock recommendation. Now, Accelya provides accounting software solutions to global airline companies. This is listed in both BSE and NSE. Let me zoom this. So they had their board meeting last month on 24th of April. So it's exactly 1 month now. Uh, so let's go through their quarterly report, financial report. They have their standalone and they have given consolidated as well. Let me go through standalone first, then I will go to this consolidated financial statement. It won't be very different from standalone. So this is their standalone financial statement for the last quarter. If you want to see the share price for Accelya Solutions, it's 1400 rupees. So the market cap for this company is 2000 crore, which is 20 billion in rupees in that unit. So here we have the revenue for last quarter, that is this is in lakhs. So lakh, 10 lakh, that is million. So 130 million for one quarter. Compare this to year on year, this has some growth before, because it was only 118 million for the same quarter last year. Now it's 130. So it's about 10% of growth, and compared to last quarter as well, there is some growth. Now this is the total income, the other income which is in note 4. This is not much. So it's 136 million here compared to 129. So 7 million of this is like 5% of growth, not 10%. So here on something is wrong. This is already lakhs. Okay, something is off. Something is off. This is in lakh. So this is 10 lakh or 1.3 billion. Okay, I beg my pardon. So this is in lakh. Whatever figure we have, this is in lakh. This is 10 lakh. So 136 crore. Now, if we compare the 9 months, see the financial year for this company is 30 June 2024. So basically, they considered their financial year to be from July to June rather than the normal April to March. So here, their total revenue for last year was 470 crore. If you take round figure 500 crore, 500 crore, its double would be 1000 crore, and then double would be 2000 crore. And that is what the company is selling for. So company is selling for roughly 4 times the revenue. Company is selling for roughly 4 times the revenue. The total revenue for the 9 months from 1st July till 31st March so far is 387 crore. For the same time period for last financial year, it was 355 crore. So there is a difference of 32 crore, which is uh, roughly 10%, less than 10%. It's like 8% increase in the total revenue or total income. If you compare just for this specific quarter, it went from 129 crore to 136 crore or 137 crore. This is not a high growth company. This has very specific clients which it serves. It's a software company, but it is in very specific field, so it doesn't have high growth. But what it does have is high dividend payout. So again, an increase of 7 crore, which is very less in this. So this specific quarter doesn't have high increase, but maybe previous quarters had higher increase compared to year on year. Last quarter was just 127 crore. Now let's come to expenses. The total expenses was 92 crore out of 136 crore. For the same quarter last year, it was 75 crore. If you take for the 9 months period, it's 258 crore of the 387 crore. So that leaves roughly 128 crore in hand as profit. And this was 130 crore for the last year. So the profit has gone down slightly. The total profit for the last financial year was 168 crore. So right now we have 138 crore. If it makes another 40 crores of profit for the next quarter, that is April, May, June quarter, then it will make the same profit as it did for the last financial year. So this quarter the profit was 44 crore. Last quarter the profit was 41 crore, and the profit was 54 crore for the same quarter last year. That is for Q4 of 2024. Okay, so the expenses have gone up. Employee benefit expense has come down slightly. Depreciation cost and other expenses has gone up. So for other expenses, we would have to check their annual statement. Uh, it would only be available for this for this last financial year when their annual statement or the annual report comes out for this financial year. Then we can check the other expenses. They should actually give a detailed explanation in the notes for this. Why has this other expenses gone up? And it was higher for this quarter as well. And if you see here, it's higher for the entire financial year as well. For the 3 quarters, it's already higher than what it was for the entire financial year last year. So we need to keep an eye on this other expense, and if it is temporary or if it's recurring. If it's recurring, that means the profit net margin for the company has come down. So 44 crore for profit for last financial year, 128 crore so far. Let's say another 40 crore, it will give something in this range of 168 170 crores annual profit. 10 times of 170 crores is 1700 crores. Hmm. 10 times of 170 crore will be 1700 crore, and the company is selling for roughly 2000 crore. So it's at a P ratio of 11 or 12, something like that. 11, 12, 34, yeah. P ratio of 12. So it will come down to P ratio of 12 in that regard. But this is pre-tax. This is just EBIT of the company. We'll need to check for EBIT, we'll need to check the enterprise value. Let's check the enterprise value. Here. I have this here. So the total enterprise value, they have total debt of 29 million, so 29 crores, and cash of 1 billion, so 150 crore cash. So their total enterprise value is lesser than the market cap. So let's say round figure, it is 2000 crore. So enterprise value is also 2000 crore. So if we take EBIT by enterprise value, it is roughly at 12 EBIT by EV, or sorry, as in PE ratio, this will be EV, enterprise value, divided by EBIT. If we take enterprise value is what the entire company is selling for, and EBIT is the total income of the company, that is at ratio of 12. Now there are taxes which is less than 25%, something in the ratio of 22%, I guess. Now you see here, for the same quarter last financial year, they had an exceptional item which was basically some building in, I think in UK they had some building which they had sold and they had made a loss on that, so that was subtracted. It was not an operational loss. They had to sell it for less than they had acquired it, or less than the uh, value, I guess, which they had ascertained, and so they had to show a loss in the income statement, but this is not a recurring loss. So the comparison for this quarter with this quarter would be wrong, and therefore when we take this profit for the entire financial year, we have to add both of those up, and this is the real profit, not this number here. So you will see a certain amount of growth for the 9 month period, and next quarter when their entire financial year data comes out, you will see a certain amount of growth. Let's say that would be in the range of 170 crore, and if you compare that to 95 crore, it will look like the net income has essentially doubled, but that would not be the case. The net income would remain roughly the same. There would be an increase of 5 to 10%, somewhere in that range only. One way to compare that is through the taxes. See, the tax is pretty similar for all 3 quarters here. If you compare for 9 months, it's pretty similar. It's slightly higher. That means the profit is only, let's say, 10% higher than what it was for last financial year for the first 9 months. And so, when the total taxes for this entire financial year will also be something in the range of 44 crore compared to 40 crore for last year. Then we have this profit for entire year. Can I zoom it further? Then there are other remeasurements of defined benefit obligations. Since these amounts are very small compared to this row, we don't need to worry about the smaller figures. Total comprehensive income, which is pretty similar to the profit for the period. So on a per share basis, this comes out to be 22.27. This is EPS. For last quarter it was 20. So for 3 quarters so far it is 64 rupees. And this is down for the same quarter for last financial year because of this figure which was added to the income report. So this is not 64 compared to 43. It is pretty similar actually. This would be something in the range of 63, 64 as well. So this EPS for the total year, for the entire year, for the last financial year, is given as 62, but in reality it is 82 to 84, somewhere in that range, and this year will end somewhere in that 84, 85, 86 rupees as well. So we have the notes here. They have given this exceptional items. See note number 5. Exceptional items for the quarter and 9 months ended 31 March 2024 and year ended 30 June 2024 comprise of impairment of investment in its subsidiary Accelya Solutions UK Limited as a result of reassessment of future prospects on account of business environment of whatever. So either they had sold that property, I think they have sold that property, or they have done a reassessment that the value of that property has gone down. So they have already shown a loss. This is loss only in the income statement, but if you check the cash flow, they haven't lost any cash on that. So that's why I said while their profit was 62, not worrying about other changes, their actual cash flow was 82 or 84 rupees. Now this is other income, refer note number 4. Other income of quarter 9 months includes 830 lakhs as dividend received from subsidiaries. Okay, 830 lakhs. This is in lakhs, so 830 lakhs would be substantial. 8 crores. And year ended. So this includes 830 lakhs. Okay. So they have fair bit of dividends as well. Okay, this is good. So in standalone, they have dividends coming from their subsidiaries, but when we check for consolidated, they won't have dividends. That total income would be added to the income and total expenses would be added here as well. But the difference shouldn't be much, because if you take 830 lakhs of other income, 8 8 crore. So here we have 12 crores of other income, and only 8 crore of that is coming through dividends of the total revenue of 374 crore, or 387 crore rather. Only 8 crore is coming as dividends. So it's not much. Now the EPS is 22, and the overall EPS, let's assume for the year, would be 84. So 10 times of 84 is 840. Let's take round figure 850. Double of that would be 1700. Now a share right now is selling for 1400. So it's in the range of 14-15 p. This is 16.5 p. Is if the share price comes down to 840 in that region, it would essentially be selling at a P ratio of 10. P ratio of 10. Deloitte is their accountant. Now we have the consolidated report here. It's not very different from what we had earlier. So 136 crore. So let's check directly for 9 months. 396 crore compared to 382 crore for last financial year. For 9 months period, for entire year it was 510 crore, and it has 396 crore. So if it makes another 126 crore, it will be above this figure. In other operating revenue is not much, very small. See, other income right now is lesser because in the standalone we consider the dividends coming from their subsidiaries, but for the consolidated, their total revenue and uh, expenses gets added to the company's revenue and expenses. So for this quarter, the total revenue was 139 crore for the consolidated, that is the standalone company plus its subsidiaries for Accelya. Compared to the last quarter, it was 136 crore, so it has gone up slightly, but doing a year on year comparison, the total income was 133 crores, so there's not much increase. For entire 9 months period also you can check, it is 405 crores compared to 389 crores, so about 16 crores, which is like 5% 4% increase year on year. The total income for entire financial year, last financial year, was 520 crore. For this financial year it could be in the range, in the same range, could be. Expenses as well, the total expenses is pretty similar. It's actually slightly lesser. For 9 months period it's pretty similar, and so it should be similar for the entire financial year as well. The other expenses has once again gone up, and we will need to check that in the in the annual report once that comes out. So this is the problem with Indian companies, they don't give this breakup details for each quarter. You have to wait till the end of the year to get the annual report to figure out what the increase was for. You can go through their detailed announcements, each of the announcements, to check. They may have referred to it somewhere, but generally speaking, Indian companies don't provide a complete breakup of each line item for the quarterly data, for or the quarterly report, which you see in American companies. In the US based equities, they would be providing a complete breakup each quarter, so it's far easier to analyze. So it's pretty similar, not much difference. See, if you add these two, this is 129 crore compared to 127 crore here. So total would be 170 crore. We will have to check the minority interest as well. I think the subsidiaries are standalone subsidiaries, or I mean 100% subsidiaries. They don't have any minority stakeholders there, but I will have to check. Income tax is pretty similar compared to the last year. Total income is pretty similar. If you add these two, this would be 9.5 or 95 crore. This is 95 crore. So you may ask, if there is no growth in the company, then why should we pay a higher PE ratio? The PE ratio should be on the lower side. Now, is PE ratio less than 15 low enough? This company has a very high dividend payout ratio, almost in the range of 80 to 100%. I will check that later. So if the price goes down from here, if it goes to less than 10 PE, then essentially it would be paying a dividend yield of 10% or higher, and that's a good return because with dividends you are getting solid cash in your hand. So there are other remeasurements, exchange differences on transactions of foreign operations. So these are not very high amount. This line, if you look here, it's 342, 353. This is essentially 3.5 crore. This is 3.4 crore. It's not very high compared to overall figure. It does make some dent. From 62 crore it comes down to 59 crore. But once again, if you look at the overall earnings at 60, near about 64 rupees, I'm not too concerned about decimal places. You have to take round figure. So it's near about 64, and it was about the same mark last year as well for the entire financial year, but that includes this exceptional item. So it was around 82, 83, 84 rupees, and it will be around the same figure for this financial year as well. What is this? 1367 million, 1.36 billion. So basically what they are saying is 136 crore income. Let's check. 136 crore, 136 crore. Where is profit? Wait, what? This is 136. Oh, income as in revenue. Quarter highlights. Accelya Solution, Accelya Group Company, leading provider of financial and commercial solutions to airlines, has recorded consolidated opening income of itna million for the quarter, 1.36 billion compared to 1.31 million. PAT stood at 300 million compared to for a quarter 3 billion, so 1.2 million. Financial and business intelligence solutions to airlines, hosted an outsource and pay per use model. These innovative models are beneficial for customers since they reduce upfront capital investment. The return on investment on pay per use model is quite fast since the business benefits of the solution pays for itself. Business critical financial, commercial, cargo and analytics solutions for more than 40 years to 50 airline customers. I wonder if they are current 250 customers or they are adding all of the customers they had over this 40 years of period. Goes on and on. Now I want to take the overall look at the company. So I have this Accelya Solutions here. So it has a high dividend yield. Total shares outstanding is 14.9, so 1 crore 49 shares, right? A million is 10 lakh, 10 million is 1 crore, so basically it has 1 crore 49, 1.5 crore outstanding shares. It has a PE ratio of 16.5, but that 16.5 is based on the reduced profit for the last year because of that exceptional item. EV by sales is 3.7, EV by EBITDA is 10, price to book is 7. Since it is a software company, the price to book doesn't hold much value, and it pays out. It has a very high dividend payout ratio as well. So all of the earnings it has for the financial year, it pays back to its shareholders. So it doesn't increase its book value over the years. Like I said earlier, the total enterprise value is less than 2000 crore or 20 billion. Market cap is 20 billion. The total sales compared to this 20 billion was 5 billion for this would be for last 12 quarters, last 12 months, so last 4 quarters. So it is selling 4 times the revenue, and roughly, yeah. So the P ratio is not 20, it's 15, right? It's 15 or 16. So net income is, if you compare to this, it's roughly, oh, 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 oh. So it doesn't look like 15 times, it looks more in the range of 20 times. Sales hasn't grown much in the last 5 years, so it's not a high growth company. EBITDA CAGR is not high as well. Net income has not grown, so it's not a growth company. It's a high dividend payout company. So if the share price comes down, then it becomes very attractive. Right now, it has a dividend yield of nearly 7%, 6.5%. As the share price, if the share price comes down and the dividend yield goes higher to 8%, 9% range, it will become very attractive. Anyone who is looking for high growth companies should stay away from this. So here we have the financial statements for last 10 years. If you look at the total sales figure, it has grown from 3 billion to 5 billion. So it is not even double of what it was 10 years ago. So it is not a very high growth company, but there will be some growth. During COVID time, it took a hit from 4 billion, it went down to 2.87 billion, but now it has come back up to 5 billion. I don't think it will grow very fast for next few years. If it doubles for 10 years, yeah, the growth would be in the range of 4 to 5%, which is not very high. Because it has very specific set of customers, it's very difficult to grow without acquiring new customers. It has high gross profit margin, 70%. Even net income margin is, sometimes it's high, it goes up to 26, 27%. On the downside, it was 14%. This was that COVID year, but then it's in the range of 18 to 20% a lot of time. Actually, it used to be much higher pre-COVID. It was in the range of 20 to 26%, but now it's varying a lot. Let's see what it will be for the next financial year. But again, this has come down due to that exceptional item, so it will be in this range of 20 to 25%, somewhere in this range. If you look at the EPS, so it's pretty consistent. The earnings per share, it's in that range around 60 rupees, and then now it's going up to 84, 85 rupees for this financial year 23. This is June 23. It was 85, then it has come down to 62 because of that exceptional item. Without that exceptional item, it will be in this range of 84, 85, and then for this current financial year, which will end in June, it will again be in this range of 84 rupees. If you want to check the quarterly data, so see the growth for the quarter was only 4%. This is year on year. So Q3 FY25 compared to Q3 F425, it wasn't very high. The income for every quarter is in this range of 2020. Only for this year it went down due to exceptional item, but if you can check the EBITDA level, it was exactly the same, more or less in the same range. So it makes about 21 to 22 rupees every quarter of EPS. So in 4 quarter, it will be earning 84 rupees. And if it can sustain that, then in 10 years, it will be earning 840 rupees. In 20 years, but let's say in 10 years, it will still double from the current range. And 10 years from now, it will not be earning 840 rupees for 84 rupees per share for 1 year. It will be earning 160 rupees. Growth is slow, and it's only keeping up with the inflation. It's not very high. It's actually not even keeping up with the inflation. Inflation would be 6 or 7%, and then they provide their service in dollar, but they pay their expenses in rupees, in Indian rupees. So they should get the benefit of that as well, as rupee continue to fall against dollar, as $1 from the current 86, 87 rupees. Um, that is the exchange rate right now. For $1, we have 86 or 87 rupees. If that continues to go up to 90, 9500 in future years, in coming years, that will benefit this company massively. So exporters always benefit from weakening rupee. Importers don't like it. However, if the dollar weakens, then exporters won't like that. Now let's come back to our income statement. We have already seen this. There's the other operating income which has gone up. So we need to keep an eye on this. So operating income has become 4 times what it was 10 years ago. So while the total income has not even become double of what it was 10 years ago, the operating income has become nearly, or let's say roughly 3 times, just over 3 times, not exactly 4 times, but just over 3 times what it was. So we need to check for the other operating expenses, and if the company would be able to control that, then the profit margin will go up in coming years. If the if this operating expenses continues to go up, then the company will continue to make, then there will be no increase in their net income margin. Net interest expense is not much compared to this operating income, so we will ignore that. This is their earnings before tax. Then they have their, this was exceptional item for the last year. Then they have their income tax here, and this is their total earnings. So for last 12 months, it's now back to the same range it used to be earlier. So it's in this range now. Now I'm giving too much attention to that exceptional item because it's very easy to miss that. We can easily say the profit went down, but in reality the operating profit did not go down. It was only the other comprehensive income where the profit went down because of the exceptional item. In reality, they did not lose money by doing business. They lost money as the value of the asset they were holding went down. And that is not recurring. That is the point. It was a one time thing. Now let's check the cash flow. They have their net income. See, we don't have cash flow for this current financial year here. It will only come after the next quarter report comes out. But if you look at the cash from operations, at least for last few years, you will see the total cash generated was more than its prior year, as they had added back that other operating activities cash. They have added that back as 285 million rupees. It was 332, so there would be other expenses as well. They would deduct that and add back the amount. They have some amount of depreciation and amortization as well. So we will have to check. This is pretty consistent and it has gone up from this level. We will have to check what their uh, capital expenditure is. It wasn't a lot for the last year. Maybe they acquired buildings and other stuff, and they would have uh, some R&D activities or some research or some software which they would be building to provide solutions. Then they do some investments in securities market. As long as cash from investing is negative, it's a good thing. Positive cash from investment means they are selling the investments which they hold, which is not a good thing. But this positive amount was very small compared to this negative amounts around it, and it looks to be a one-time thing, so it's good. And then they don't have much debt. They have repaid some of their debts, and they pay a high amount of dividend. If you look, they have high amount of free cash flow compared to their net profit, which is again a good sign. If you look at free cash flow per share, last year they made over 100 rupees, but before that was 80, and I think it will come down to somewhere in this range, 80 to 100 for this year as well, which is a good thing. And so they end up paying a lot of dividend as well. If you look at the dividend data here in the income statement, I forgot to check this. So it has very high payout ratio in the range of 80 to 86, 90. Dividend per share has been consistently high at this level of 65 for last 3 years, and now it has gone up to 90 for this current year. Let's check their balance sheet. Now the company is selling at a price which is uh, which is at a fair price right now. If the market cap of the company doubles from this point on, then it won't be as attractive to buy, as the dividend yield will cut in half. But if the share price becomes half of what it is, from 20 billion it goes down to 10 billion, that is 1000 crore, then it will be yielding about 13% of dividend yield, which will be very attractive. So when the share price goes down, it becomes very attractive to buy. When it goes up, it's not so attractive from this level. That is my point of view. So let's take a look at the total assets of the company. That is more like 4 billion, which is 120% of the market value. Again, this is for last financial year. Most of this is in current assets. There are very few non-current assets, which is mostly property, plant and equipment. They had some goodwill which they had written off. This was the exceptional item. They had written off this goodwill. So they would have acquired some company or bought some property, and they had a goodwill of certain amount which they reassess and write it off. Other intangibles, this is hardly any asset. Uh, you can count this as an asset only in the good times, but if the performance of the company goes down and let's say the company is going bankrupt or whatever, it's very hard. In this case it's a software company, so it's very hard. It only has operations, it's only need office space and some laptops, so it's doesn't have a lot of expenses, so it's very hard to go bankrupt for this company. But this is intangible. don't I don't give much value to intangibles because it has meaning only in good times. In bad times, no one will be buying its assets, intangible assets, at this rate. If the company is selling for 10% of this value, maybe someone will come and acquire that, but no one will acquire at this rate. But 75% of its total assets are current assets, and those are cash and receivables, which is a good thing. Receivables, once again, if you compare to overall revenue, which is 5.2 billion, so it's about 20% of that money is receivable, and that is pretty consistent. So it's a good thing. If you look at the overall cash level as well, it is holding high amount of cash, which is again a good thing. Now let's look at the breakup of the total liabilities and common equity. And once again, liabilities are not very high. Whatever liabilities it does have, most of it is current liability, 900 million, and the breakup is 400 plus 300, 700. This is 800. So this is accounts payable, maybe salary and other stuff, and accrued expenses. So this is total is about 3 and 4, 700 out of the 900 million here. Then current portion of leases. So they would have leased some office, they would be paying for that. Good thing is they don't have much of long term loan. They don't have any long term debt here. What they do have is long term leases, and that's fine. They have lease, do they have property as well? They might have added it on this side as well. So what they put in as depreciation could very well be the rent which they are paying out. So don't fall for the trap that depreciation is not real expense, because what they do is they have certain amount of depreciation here, and they will say, see, depreciation is not real expense, so they will add it back in the cash flow, but then they will subtract it as capital expenditure. This is not capital expenditure, it is real expense. It's basically a rent. So if you look at the common equity of the total assets of 4 billion, 2.8 billion is common equity, only 1.2, 1.3 billion is liability, and most of it is in retained earning, which is a good sign. If the retained earning of a company is going up, that's a good sign. It has become 4 times and it pays a lot of dividend. If it hadn't and hold on to that cash, this retained earning would have gone up through the roof. So it's a good sign. The only thing is, If you consider this round figure 3 billion, we are paying roughly 7 times of that for the equity. Now, if the company were not paying out dividends, then it wouldn't be such a good thing. But since the company is paying out all the earnings to its shareholders, I like this at the current dividend level. Now, that's a very personal choice. Right now, it's 6.44%. When the share price goes down slightly uh, and it goes up to 8%, 9%, then it would be fabulous buy. What That's what I think. If the dividend yield goes up above 10%, it would be very good buy. But since the dividend yield itself is not very high right now, it's at the level of what you get in bank deposit. If you do a term deposit in bank for 1 year or more, you will get somewhere around 6%. And so dividend yield is higher than that. And I think there's a lot of safety in this company. I don't see their income going down magnitudely. Book value is 200 rupees. So look at the market cap. So if someone would have bought it at this level, they would right now be making very high amount of dividends on their buying price. Let's say at 14 15 billion rupees, they would be making around 10% of that as dividends. If you buy it at high amount, the dividend yield will not be high. So when the dividend yield is low, the share price, let's say, will always, or the market cap will always revert to the mean. When the dividend yield is high, other people will come and buy in to reduce that dividend amount. If the dividend yield is low, that means the share price is high, then people will not look to buy that. So there will be less buyers, more sellers, and the share price might come down. So all in all, I like this company and would love to buy it if the share price or the market cap falls in half. But whether it will fall in half or not, I have no idea. Actually, no one has any idea. Return on equity is high, return on total capital, return on common equity, everything is high. So that's the point. The net income margin is high as well. It's usually in this range of 24%. If you take 1.2 billion of 5.2, 5.2, 2.6, 1.3, so it will be in the range of 24%, which is high. Only problem is it doesn't have growth, but had it had 10-15% growth, the company would easily be selling at P/E ratio of 30-40. Had it, in the current market scenario, had it had 20% growth, company could easily be selling in the P/E ratio of 80-90 in today's market scenario, which would not be a good sign for buyers. So the P/E ratio is down because everyone knows that there's no growth in the company, but it's a solid dividend company. Return on assets, return on equity, it's all high. Solvency, yeah, it is a very high. Altman Z score. I don't know how they calculate all of these, how they calculate the Altman Z score, but higher it is, lower is the chance of defaulting. It doesn't have any loan. It only has some amount of lease, so it can't default. That is also a good sign. Return on, once again, return on invested capital is high. EBIT, no PAT, net operating profit after tax. But to do the real analysis, we also have to include any amount of we shouldn't do analysis by excluding tax. Today the tax is somewhere in the range of 22%. In future it may come down or it may go up. Government can decide to reduce it to 18% to 15%, or government may decide that the taxes should go up to 30%. So if you are analyzing the company, we have to analyze based on EBIT, income before interest and taxes, not by excluding the tax. Government can also decide to take 100% of the income as tax. That doesn't mean company is a bad company. Yes, we as the equity holders we have to check what we would get after tax, but any analysis of the company by excluding tax is not real analysis. And Warren Buffett says this as well. You have to include taxes while analyzing the company. Taxes are also paid out of the income. Interest is paid out of the income, though interest had to be paid anyway. But we want a company which is making a lot of money, and then of that money it is making, it can decide to choose whether it has to pay interest or taxes. You don't have to choose, you have to pay taxes. But when you're making a lot of money, then you have to pay taxes. If you don't make money, you don't pay taxes. Government is just your business partner. In that way you can regard it as your business partner. So all partners combined, whether you are equity holder or debt holder or the government, combined you make profit in the company, which is EBIT, earnings before interest and taxes. This interest is the debt holder's profit, the tax is government's profit, and then whatever you are left with is your shareholders' profit. And if this is the amount of profit you are making on this invested capital, that's like 50% of whatever you have invested in the company. You are making 50% on your capital. The government can tomorrow take 100% of the profit. Those things are not in our control. Obviously, as shareholder, you would lose money because your share price will collapse. But again, these are not controllables. If you are analyzing how good the company is, we have to consider that EBIT is the real earnings and the enterprise value is what the company is selling for. So that's all for this video. Thanks for watching.